The stock market is up huge today. My own portfolio is up more than $4,000 on the day, and I'm not selling a single share of my stock. In this video, I'm going to tell you why the market's up. I'm going to tell you why my portfolio is performing well today, and I'm going to tell you exactly why I'm not buying and selling shares. I'm going to continue to hold the shares that I own and hopefully buy more over time for the long term. As always, we always start off looking at the real money portfolio. We're building this thing up to $1 million right here on this channel. So like the video, subscribe if you want to watch that journey. We're at $44,900, up $4,300 on the day, which is up almost 11%. If you've been watching the videos, I share the whole performance since we opened the portfolio on February 15th. We are now down 8,900 total, and we put 54,000 in. This says down 44%. It's not that much. If you divide 8,000 by 5,400, it's actually down less than 20% at this point. And if we have another couple days like today, then the portfolio will be in the green overall. Reason number one, I'm not buying and selling in and out of these companies based on fear, because if I sell on fear, I'm never going to make up that gain. And this is money I don't need for 3+ years. And I'm designing this portfolio to invest for the long term, that people with jobs that don't stare at the market all day can follow as well. Let's just talk about some of the stocks that are up big today and some of my largest positions. Snowflake is up almost 10% today. GitLab is up almost 18% today. Datadog is up 7%. Tesla is up 5%. Who knew we'd be talking about Tesla on this channel? Only up 5% compared to some of the other things. Cloudflare up 14%. Mongo Database up 15%. Bill.com up 16%. Now let's get into why are these companies moving so much? Well, the cloud and growth sector has just been crushed and destroyed and beaten down. What I'm paying attention to is owning companies that I want to own through rate changing environments, whether rates are going up or going down. Businesses that I believe are going to be better businesses and larger businesses in the future than they are today, because they have products that matter, that people love, that either serve other businesses, or in Tesla's case, disrupting EVs in the auto industry, obviously getting into solar, getting into robot, all those kind of things. Those are the types of things in the way I invest. And let me show you why I'm not considering selling GitLab because it's up 18%, or Cloudflare because it's up 15% in a single day. This is Alphabet, Google, right? And if we look, this is what Google has done over the last 17.7 years. It has compounded 23% per year. That has turned a single $10,000 investment into $416,000 over that same time period. The S&P 500 has turned $10,000 into $41,000, which is compounded at 8% a year. Still fantastic. And if you're doing, more than 10,000, if you're adding every year from 2004 to 2022, you've done even better investing in Google or the S&P 500. And so that's the type of long-term performance that I'm after. So then the question becomes, how do we find companies that can have and give us those types of returns? And what size should those companies be? And this is why I'm not selling the companies that I own. If we look at Google, this is a chart of Google's revenue each year since 2002. In 2002, they had $439 million in annual revenue. In 2003, they grew that to $1.5 billion. Since 2003, they have grown and grown and grown and grown their revenue all the way to $257 billion in revenue per year. That has grown on average a compound annual growth rate of basically 40% per year. So if I'm finding companies early that have less than $1 billion in annual revenue, that can even grow their revenue to 10% of what Google has grown its revenue to, if they could just grow their revenue to $25 billion a year, 10% of Google's annual revenue, then the returns could still be fantastic over 5 years, 10 years, 15 years, and even 20 years potentially. Here's another example. I just chose Google, right, which is one of the largest companies in the world. right? And let's look at ServiceNow, which is a much smaller company than Google. It's got an $86 billion market cap. Let's see how ServiceNow has performed. So if we go to Max, since 2012, so over basically the last 10 years, ServiceNow has compounded at 33% per year. Let's jump back to Google and look at that. ServiceNow has actually outperformed Google 33% compound growth to 21% compound growth since 2012. Let's jump into ServiceNow's revenue numbers and look at how much their revenue has grown since 2012 to today that has produced that type of return. Back in 2013, ServiceNow had a price to sales ratio of 8. It has now expanded and grown to a price to sales ratio of 13. And so if we take that from 2008 to then, you see that 33.5% return. What did that return come from? That return came from the revenue growth and the price to sales multiple expanding from 8.8 to 13.6. So one way to have outsized returns is to own companies at a price to sales multiple or a PE multiple if you own companies that are valued based on PE, and have that multiple expand or grow as revenue or earnings grow. We're in a situation now where I'm not expecting the price to sales multiples of the companies I own, and I'll show you why in a minute. I don't expect those price to sales multiples to expand. I'm actually expecting them to contract, to shrink significantly over time. But I think because of how early they are and how much their revenue is going to grow in the future, I'm willing to pay too much or too high of a price to sales multiple for these stocks because I think that they have long enough revenue growth trajectories ahead to where I'll still get great returns. So let's take a look at ServiceNow in 2014 when it had a price to sales ratio of 20. And now it has contracted to 13.6, which is roughly 20 to 30% contraction in price to sales multiple. But because the revenue has grown so much, even though the price to sales multiple has shrank from 2014 to 2022, and it was at 20 and now it's at 14, you still, investors, if they held and added over time, would be even better. But just from that single point, if they held, they got a 25% annualized return. If you look at investors and the greatest investors in the world, a 25% annualized return is amazing. It's fantastic. So that is an example of how even if you pay too much in the multiple, the price to sales multiple contracts or shrinks over time. If you're in the right companies and you hold them long enough, you can do just fine. Let's take a look at ServiceNow's revenue growth over that time period. And so if we look back to 2016, ServiceNow had $1.4 billion in revenue, which is more than most of the companies in my portfolio. Since 2016, ServiceNow has grown revenue at a compound annual growth rate of 33.5%. So that's 1, 2, 3, 4, 5 over the next 5 years, growing off of $1.4 billion. That's going to be important to remember as we look at the companies in my portfolio. So first up, we're going to look at Snowflake, which is one of the largest companies in my portfolio. And we can see that they had in 2019, they had almost $100 million in revenue. 2020, they jumped to $264 million. 2021, $592 million. And then this is fiscal year. That's why it shows 2022. It's different than calendar year. $1.2 billion in annualized revenue, growing at 132% per year. So if we remember ServiceNow, from the time that ServiceNow had $1.2 billion in annualized revenue, ServiceNow has grown revenue in the 5 years since it had $1.4 billion in annual revenue at 33% per year. So now we have to think about the current multiple and valuation of Snowflake. There are a lot of people that say, I would never own Snowflake because the price to sales ratio is too high. They have a blended price to sales ratio, which is a weighted average of the most recent actual value and the closest forecast value. That just means that you may see a different price to sales ratio if you look at Yahoo Finance or Google Finance or a different source. So this is just based off of fast graphs and the way that they calculate it, but that's okay. It's at 28 right now. We're going to go to forecasting, and we're going to go to custom, and we're going to look at the current estimates, which analysts have estimated Snowflake's revenue based off what management has said, plus growth trends that they see to be growing at 60%, then 54%, and then 41% per share through 2025. Remember, ServiceNow was able to grow revenue off of a pretty large base at, roughly 30% per year. So I'm just going to guess for the years after that, and I'm going to put that growth rate at, we'll call it 25%. And then I'm going to take the price to sales ratio, and I'm going to put 10 in there. And what I can do is I can take this dot from here out to 2028, which is 6 years from now. And that sounds like a long time, but if we looked at the years after ServiceNow's, their revenue growth or Google's revenue growth, it's not unheard of for companies to grow revenue at that rate in larger basis for multiple years if you own the right companies. So even if they drop down to a price to sales ratio of 10 from 28, if they hit these numbers, which Snowflake and great companies tend to beat analyst expectations over the long term. It's always possible they miss them. And then it drops pretty significantly from 41% down to 25% and stays at that for a couple years. At a price to sales ratio of 10, down from currently 28, you're looking at a 14% annualized return. If they're somehow able to average 30% growth over those next few years, then that's going to significantly change that. And our annualized return is 16% per year at a price sales ratio of 10. And if the price sales ratio goes up, the return gets better. If it goes down, even all the way down to a price sales ratio of 5, you're still looking at a positive return in that scenario over the long term, down from a price sales ratio of 28. That is why I own companies like Snowflake. Let's do the same thing with GitLab. They're actually growing off a smaller revenue base than even Snowflake. And so there's the chance that they have a longer, bigger growth runway ahead just based off the numbers. Again, it's all going to come down to individual companies. But let's look at GitLab. GitLab is trading at a lower multiple than Snowflake, at a 20 price to sales multiple. And so again, we're going to do estimates out to as far as they have them. We're going to take it down from 35% down to 25% growth. So now you see 25% growth in 2026, 27, and 28. And we're going to take this line from here. Oh, we got to change the price to sales ratio scale because we want to take that down. And so down from your price to sales multiple of 19 to 10 with pretty reasonable growth rates, in my opinion, revenue growth rates, you're looking at an 18% annualized return. But again, I don't know what's going to happen in the short term, and I don't know how far the price sales ratio is going to compress and go down and how far the stock's going to go down in the short term. But I've studied GitLab's business. I've studied the industry. I want to be invested in the company. And this is simply seeing if the valuation makes sense. If you want to learn more about these companies and what the businesses do, I go deeper into them in my email newsletter, austin.substack.com. We're just talking about, are these businesses somewhere in the realm of reasonable valuations? And I think that they are. And this is how I come to those conclusions. And let's do Tesla. Tesla's going to be a tricky one because it's not a software company. The gross margins aren't as high. But we could still use price to sales for it. Tesla does have a lot more revenue than the other companies I'm talking about. They had 53.8 billion. And so at some point, how large can they grow revenue? So we'll see about that. And depending on the markets they get into, I guess there's a lot of growth there. But again, a lot has to be proven. So a ton of risk with Tesla, in my opinion. There's people out there that act like Tesla, there's no risk and everything's guaranteed. I own Tesla, but I think there's a ton of risks in Tesla. I think there's a lot of opportunity for upside, and it's a fascinating company, which is why I own shares. But if we go to analyst expectations and we go to estimates, and analysts are expecting 22% growth out to 2024. So let's take this to 20%. and we draw it. And right now the company has a blended price sales multiple of 12. If we take that out, even down to a price to sales multiple of 5 on those numbers, you'd be looking at an 8% or 7.5% annualized return. If it had a price to sales multiple of 10, which if they don't raise their margins, then I don't think it would deserve a price sales multiple of 10, but things don't always trade on what they deserve. So if it had a price sales multiple of 8, you'd be looking at a 16.8% annualized return. A price sales multiple of 10, you'd be looking at a 22% annualized return. I have no idea where it trades, but in all of those scenarios, you're still making money. And again, it all comes down to if they can execute and grow revenue at that rate for that long. So we'll see, and there's a ton of unknowns. They could crush it all. Who knows? And the last one we'll do is Cloudflare, because I want to get you out of here. It's Friday. Hope you're going to have a great weekend. If you like this content, just do me a favor, like the video and subscribe. It really helps me out, and then you won't miss an update. And then again, check out my email newsletter, austin.substack.com. And if you're looking for an investing community and insights and verified recommendations from people, you can, if somebody's recommending something or writing about it, you can see if they own it or not. Commonstock.com is the best investing community on the web. I absolutely love it. Let's get into Cloudflare. They're at $656 million, growing at 50% per year. So again, we're going to take the estimates. They've got them 33% in 2024. Let's bring it to 28% per year after that. Let's bring the price to sales ratio down, get it to 10. So we're up at 23 right now. Even if it's trading at 10, which is a more than 50% contraction in price to sales multiple, you're still looking at an annualized return of 13% or a double on your money. And so, it would be profitable all the way down to, basically a price sales ratio of 5.5 or 6. You're still making money over that time, not a lot. But then obviously if it goes up and is higher from 10, price sales ratio of 15, you're going to get a 21% annualized return. Again, there's a chance they beat these numbers. That makes the returns better in those scenarios. There's a chance they miss the numbers or whatever. So there's always risks. But this is why I'm not selling out of my companies, even when they're up 10, 15% today. I want to be invested in them long term. I want to continue to learn about them, research them, study them, and buy regularly every 2 weeks, which I share right here on the channel. So like these videos and subscribe and help more people find us. Don't miss an update. And follow the journey of trying to build this portfolio to $1 million. We're not going to sell when our stocks are up 8% or 10% in a day. That's how you miss the next, life-changing potential returns.